Hello and welcome to this catch-up for the Switzer Dividend Growth Fund. We're talking to the portfolio manager, Shawn Burns. I'm Peter Switzer. I'm very keen to see how the fund's been going. Shawn, thanks for joining us.
Pleasure, Peter.
Okay, so give us, our viewers, a summary of the objectives of Switz.
Right, Switzer Dividend Growth Fund is yield and quality focused. So it looks at the broad cap, so mainly larger companies. So it keeps towards the quality end. And so the objective of Switzer Dividend Growth Fund is to concentrate on yield. So it looks at quality companies that can pay big yields going forward and sustainable yields, and also over the long term to generate capital growth in the fund.
So how have you been tracking against this objective?
We have been generating lots of yield. So over the last year, it's been like 6.5%, I think, and over 8% grossed up. So that's a lot of yield, and we see that continuing. That should continue at those type of levels. In terms of capital growth, it's moved around with the market. It listed at 250, and it got up to around 265, down to the 220s, and now back up to 250. So it has moved around with the market, but it has consistently paid out a pretty good yield.
And Shawn, so over the past 2 years since inception, have we been getting a return around 6% or so?
Yeah, that's what we've been getting, Peter, and that's a mix of dividends that are paid out by companies and realised capital gains. If you reinvested all your dividends, and I know this because I have, you've ended up with over 10% more shares in the fund than at the start. So that's reinvesting those dividends, and now it becomes interest on interest. As more income comes in, it'll continue to grow.
Yeah, it's a very, very important point, and a lot of people who often ignore the dividend reinvestment plans probably regret it now.
Yep. Well, I think it's the old Buffett compound interest over time. If you can able to do that, to reinvest, it should benefit, especially with a big dividend paying fund like this one. Yeah.
So how would we track against the objective under a potential Labor government?
Well, we're watching what Labor's doing. They look like if the betting shops are right, the Labor will form the next government. Very important to watch what their policy is, but they need to get that through the Senate and what that looks like going out the other end. But also, I would probably...
We're talking about the franking credits here, aren't we? Yes.
And a lot of other policies as well, which we may see, they may emerge. But probably just two comments I'd make is the last 2 years have been pretty tough investing in Australia. You've had the Royal Commission, you've had electricity, gas, aged care, etc., a whole heap of industries being investigated and a lot of uncertainty. And I think in terms of, we'll see what Labor does, but it has been tough over the last 2 years as well in Australia. And in terms of franking credits, we'll see what that comes up with. But if you look through a lot of the companies that are paying dividends, franked or unfranked, they're the ones that are franked are offering higher yields, even ignoring the franking.
So you're not expecting an enormous change in your investment strategy?
Not due to franking, no.
Okay. How did the portfolio fare over the reporting season?
It did quite well. One of the things we measure is year-on-year dividend growth, and it got and I was expecting a pretty tough time given what happened to the markets at the end of last year, but it ended up having a weighted average increase of over 10% of dividends. Now that's a big number, and that's a good number. And what happened there was some of the big companies basically emptied out their franking credits, so paid extra dividends. So you had big dividends from Wesfarmers, big dividends from Woodside and Rio. So that's so shareholders will be seeing those
They're
dividends.
like pre-Bill Shorten gifts.
That's right. There's always an upside.
Yeah. The outlook for the portfolio, Shawn?
I think this year is going to be quite tough in the markets. That's the way we're positioning the portfolio. We're steering towards more quality, a more sustainable yield, and we think that that's the way to be for this year. And so we are batting down the hatches. We expect it to be a positive year, though be a volatile year, but we think we're prepared for that.
And it's probably in the context of term deposit interest rates falling, given what the Reserve Bank's ultimately going to probably have to do.
I think sustainable yield will become much more valuable.
Without a doubt. Well, that was Shawn Burns, a portfolio manager of the Switzer Dividend Growth Fund. I'm Peter Switzer. Thanks for joining us.